Hi, I'm Erik Schatzker, and welcome to Bloomberg's Front Row. Today, I'm talking to Dinakar Singh. For a while, he was one of the world's biggest hedge fund managers. And before that, at Goldman Sachs, he ran the most profitable trading desk on Wall Street. Today, he'll tell you investing billions and billions of dollars is way more trouble than it's worth.
You have 4 offices and people all over the place. You don't get any sleep, and you don't spend any time actually thinking about the things you love, which is investing.
Dinakar and I cover a lot of ground. This is what we talked about. How to make money in these crazy markets. What's wrong with hedge funds? Why he's worried about the next taper tantrum. And picking the best tech stocks. Here's my conversation with Dinakar Singh. Dinakar, thank you. It's good to see you.
Erik, you as well. I'm sorry that it couldn't be in person.
Me too. Dinakar, for a while, you were one of the world's most famous hedge fund managers. Before the financial crisis, you managed $13 billion. Today, that figure is under $1 billion. What happened?
Erik, I think from my perspective, it's been a journey, but ultimately, what are we doing this for? One, I want to generate returns. And second, I'd like to be happy in life. And I reached a point several years ago where those things just weren't happening. I was finding that what I was doing day to day was managing businesses, not actually driving investments. I found that I ended up with a portfolio that was a portfolio by committee. And in a market that was getting wilder and wilder, instead of being able to take advantage of that wildness, which is historically what an investor ought to be able to do when markets are crazy, we're just becoming victims of it. Frankly, not alone. I think when you look at what's happened to hedge fund returns, that is pretty much the story. Markets zig around, and that ought to be great fodder for generating returns, but it isn't showing up. People aren't generating them. And from my perspective, with kids about to go off to college in a couple of years, and staring at that, it struck me that life is long. I want to invest till the day I die. But it's time to go and in many ways rediscover both what made me happy and also what generated real returns for the next decade ahead. Looking back, I've been investing for 3 decades now, really almost in a straight line. I've seen markets all over the place. I've seen markets around the world. And I think you've got to recognize that every now and then you need to go and reinvent yourself because markets change. And if you don't change with it, then you're simply going to become obsolete. I'm
glad to hear you're happy. Not a situation that all too many hedge fund managers find themselves in right now. Dinakar, you've had rewarding years, you've had disappointing years. If you look back, why do you think it is you weren't able to make money as consistently as you wanted to, as you needed to?
I think, I think first, if one goes back, I think in years at Goldman, I would argue that I and my team were probably about as profitable as any business that the firm had. In Axon as well, it's been now a 15-year journey. We have done a pretty good job for people for a very long period of that time. But I think as I looked at really what ended up, what the business became, the reality is that, when markets over the last, call it 5-10 years, have started changing. Volatility looked like it was low, but under the covers, you saw enormous weird swings in stocks. And I think what was driving it more and more were that huge amounts of money was all going into very, I call pro-cyclical hands, right? Quant funds, pod shops, you name it. These are trillions of dollars that have one characteristic. They have to do what works and they have to sell what doesn't. And in many ways, that's the absolute opposite of what a real contrarian investor ought to be doing. So from my perspective, the problem was that when you're really a business manager, even though you want to be an investor, when markets are crazy, instead of having your mind focused just on what is going on in markets and in your companies and having 100% attention on that, instead of having all your attention focused with your team on analyzing companies and stocks, you're spending your time dealing with phone calls and business matters. It's a distraction. I mean, frankly, one reason I think why we've had good success this year is that we have not been distracted. We've been able to go, take a walk around the block when things got crazy and think through what makes sense right now.
You've written that the opportunity to make money in public markets is no worse today and arguably better than it used to be.
Yep.
Explain.
If you look at the gap between the top stocks and the bottom stocks, let's say in the top 100 stocks in the S&P 500, difference was about 70% in the first half. Now, that sounds like a crazy market, but in truth, if you go back 30 years, which is what we did, and looked at first halves for 30 years, every time there's stress in markets, the early 1990s, early 2000s, the financial crisis, that's what happens. Typically, in most markets, the gap between good and bad is 30, 40, 50%. And when there's stress, it rockets to 60, 70, 80, 90%. So when you look at the last 6 months and or a year or so, the market's actually acted normally, but in a pretty decent way. Bottom line is, if you're a stock picker and you had the right stocks, you could have made a lot of money. Now, it's not easy to do, and obviously luck plays a role in it as well. If you happen to have an airline stock, obviously that there's nothing you could have done or predicted about it. But the reality is that there is dispersion in the market. And if there's dispersion as an investor, you ought to say, that is opportunity for me.
Are you trying to be, I don't know, the anti-quant or the anti-bot? Is that, given all the changes that have taken place, is that the role that you think you need to fashion for yourself?
There are plenty of very, very intelligent people up and down Wall Street working at funds left and right. The problem isn't that their brains somehow shrink. The problem is that their risk tolerance has shrunk, right? And so for us, the easiest thing you can do is to find a situation where smart brains have looked at something and really like it. It's not that they don't want to own something, it's just that they can't because they hit their 4% risk limit and are getting stopped out, et cetera. So we like looking at things where there is a lot of short-term pain. And frankly, you find that every day. It's what is really notable about the market, even before the pandemic, and even when volatility was at record lows, was that the number of bizarre 10% type moves in a given day was simply off the charts. And that's been a phenomenon you've seen for many, many years in this building. Why does that happen? Because if everyone is short, for example, retail stocks, and a company has a slightly better than expected earnings result, it doesn't change its long-term outlook, but it means that you get massive short covering, and that stock might be up 20% that day, right? So, for example, we have been short retail stocks forever at this point, and it's a gift that keeps on giving. Every quarter or so, you get some crazy short covering rally, and then you step back and say, okay, which are the companies I like the least that people are in pain on right now, and then add to the shorts. So I think to us, that's what is really exciting. You don't even have to think that hard anymore. You can watch other people's pain and then go essentially and try and pick up the pieces.
So you're on one side trying to be, as you put it, the wolf instead of the sheep. Who's on the other side? Where are all these other flows that you're competing with? Who are they? Who are those actors?
If you look at the first half of this year, hedge funds underperform. Why is that shocking? It's shocking because normally hedge funds really do better in bad markets. That's typically it's strong markets that don't help equity hedge funds very much because you're hedged, hopefully. And so market going straight up isn't your friend. Well, that usually means that you catch up in that performance and then some in a more difficult environment. But you look at the first half of every year, the last 10 years, there's only been 1 year where the equity hedge fund index actually did better than the market. That was 2015 in the first half, and it was only by a couple of percent. That's pretty shocking. What does it tell you? It tells you that there are a whole lot of people out there doing a whole lot of trading, but not generating a whole lot of return. So who are you? Who are the sheep? Look, I think, frankly, I think when I look at, for example, many of the people that have worked for me and have gone off and started their funds, I mean, it's an exceptional group of alumni that we have out there. I think there are immensely talented people. But I think more and more these days, when I look at the hedge fund world, there are fewer and fewer people that you really feel like you can actually talk to and come away with a lot of value added in your conversation. They're too focused on trading. They're too focused on having to have only needing to own a stock that has to perform that quarter. And from my perspective, I don't see how you can succeed. And so I think the fact that everyone is focused on having very narrow risk limits and on short-term quarterly performance, I think means ultimately that they have become fundamentally worse investors. So look, I think that just means that there is alpha out there, but it's going into fewer and fewer hands.
So the hedge funds are the sheep.
I think the hedge funds are no longer the wolves. That's probably the best way to put it.
I'm still not clear on who the sheep are. Are the sheep like You know, the Davy Day Trader Global are the
Yeah,
sheep, large systematic investors. Who are the sheep?
I think it's everyone who is being pro-cyclical, right? I mean, I think so. In a way, that would be quant funds. It is short-term traders. It's, in a sense, a bit of all the above of what you mentioned. I think ultimately in this environment, uh, if you can't go and withstand some pain and think through insanity on a given day, you are going to end up giving up money to the person who can.
Have hedge funds underperformed because there's something wrong with the hedge fund model?
It used to be that there were plenty of funds to work for that were true investor funds. It used to be that you would get seated by people to go and actually have a real fundamentally driven business. Now the money is so easily available from many of these pawn shops, but the problem is that that money is very low risk tolerance, and therefore you have to invest in a totally different way. And so when you look at where the money has gone, the reality is the amount of money in the hands of real, what I would call real hedge funds, is shrinking by the day, and in the hands of machine funds, if you will, one from the other, have gone up. I was on the Yale Endowment Investment Committee for over a decade. I run the New York Public Library Investment Committee as a trustee. And so I look at it from that perspective as well. I will tell you, it's hard finding hedge funds that you really feel excited about giving hard-earned, precious, scarce capital to go and invest for 5, 10 years and really be able to sleep at night.
Isn't there an important distinction to be made, though, Dinakar? Let's talk about these pod shops. It's great to be Ken Griffin. It's great to be Izzy Englander. It's great to be Steve Cohen. It might not be so great to be one of the people working for them, one of their hedge fund managers.
Look, I think each of those, and especially Ken, I think are really remarkable people, and I think exceptionally talented businessmen. So there's no criticism of that, and it's a fantastic business model, and it is also an opportunity. But it's simply a different style of investing than what someone would do, let's say, where they're working for us. It's when you own 15 stocks with high conviction, and you have a concentrated long-term approach, that does not suit itself well to having a 4% stock. And so I think there are people that can thrive in that model. But I think, look, the one learning I've had over life is that, as I noted before, it's important to be self-aware. It's important to understand what are your strengths and your weaknesses, and make sure that you're doing things in a way that line up with that. Because if you aren't, you're going to fail. Being brilliant and clever and thoughtful, but not understanding whether or not you can do it is not helpful. And I think for many of the young, talented people that are going in these different firms, I think the advice I give them is that it could be an exceptional opportunity, but you better make sure that you actually understand the way you have to invest to go and take advantage of it. Because if you don't get that right, you're going to be out of there pretty quickly.
You started Axon as an equity long short fund, and over the years you ventured into event-driven and even activist investing. Now you're back to equity long short. What lessons did you learn along the way?
It's often the case that when something happens, whether it's in the world or whether it's in the industry or in the company, call it an event, call it a change of circumstance, call it the weather, that confuses people. People often in the short term misreact or overreact, and that gives a prepared investor a chance to go and make some money. So look, there's always a thing that causes a disruption, and disruption is your friend if you're an investor. Now, I think with activism, it seemed like a natural step to say, okay, look, we have a great company here. The assets are great. Management, not so much. So maybe we can try and fix it, make it better. And I tell you, I think the thing I have learned in life is that whether in personal relationships or in investing, if you don't like it the way it is, don't count on changing it because it's pretty darn hard to do. And the amount of energy and emotion that it consumes to do it often just gets overwhelming. Look, and that's what we found. I mean, I think our last major, we had many instances where we were actively engaged behind the scenes with good managements that were maybe a bit of a different direction, but really wanted advice. Those worked out well. When we actually found ourselves fighting with management, it just wasn't worth the grief. I mean, it just consumes you, and frankly, you end up in a situation where you really are stuck in trench warfare and you can't get out. We had a situation with Sandridge Energy, and in a sense, we won, but we lost because we ended up having to be stuck in an energy investment on a large basis for a long period of time where that fight went on. And by the time it ended, yes, we fixed the company, but unfortunately, energy prices plunged and the company went bankrupt anyway, right? So, look, I think with all this, what I've found, for example, is that distractions are really not your friend. And so don't overcomplicate things. And look, I think that's worked well for us in the last couple of years. Have as few variables as possible because we're in a crazy enough world where even one variable is probably going to go and give you a bit of angst from time to time.
Would you ever want to manage $13 billion again?
Listen, I think the answer is no. I think the problem was I had 200 and some people working for me at that time, the vast majority of which were just in the business team, meaning accounting and finance and technology and things like that. When you have 4 offices and people all over the place, you don't get any sleep and you don't spend any time actually thinking about the things you love, which is investing. And from my perspective, I don't know how to bridge that. I think ultimately, if you want to go and manage a large enterprise like that, you have to simply admit to yourself that you're not going to try to be a stock picker yourself. You're going to be a people picker and a people manager, and then they're going to go and drive the stocks. But if you can't let that happen emotionally, if you really feel like you want your hands on the steering wheel, then you've got to recognize that you've got to go and construct it the way that works for you. Because the worst thing of all is a business model where your job really, whether you admit it or not, is to be a people manager and a business manager, but you just can't let go of that steering wheel. And so you're trying to do, all things at the same time, you end up crashing.
Here we are, Dinakar, 4 months into a global pandemic, 7 months since it flared in China. What's your macro view?
From our perspective, it made sense to focus on companies you could have some predictability on, right? In my mind, I think it didn't make sense to focus on the companies that were just battered and broken. I could not begin to tell you what United Airlines earnings will be in 2 years. I haven't a clue. And I don't know how much time I could spend, and I still wouldn't have a clue. But you had great companies like Google and Facebook that were down 20, 30, 40% in a straight line. And they would be around. Their earnings might be off a little bit, but we felt good that it was more about the path and not about whether they would ultimately have profitable franchises. Managed care companies to us, I think, were the single highest conviction thing in our portfolio. We didn't understand why people were cutting earnings estimates. We actually thought they'd be going up. And in any event, even if they had more losses this year, Humana is not going anywhere. And if anything, with Bernie Sanders dropping out of the race, it was actually a positive for them. So look, there were plenty of interesting opportunities in the market. On the macro side, my observation then and still now is that there's an interesting parallel to 1998 when there was an external shock, obviously not to the same degree, but long-term capital management failed, emerging market crisis, the Fed started cutting rates and dumping liquidity in the system. That really helped fuel the big stage of the equity bubble, right? And if you remember back then, you ended up with stocks like Coke and Pepsi trading at 40 times earnings, and then that transitioned into the tech bubble that went on for a couple of years before it burst. So our view has been, the past many, many years, equity multiples have been 15, 16, 17, 18 times. Struck us that you're going to have elevated multiples for some period of time. Wouldn't shock me if it stays at 20 plus for a while. Then trying not to overcomplicate things. All right, so who the heck knows what earnings will be this year? Forget about it. Doesn't matter. What about next year? Let's just make stuff up. And struck us that coming into this year, people thought it might be 170, for example, for the S&P. If you looked at people that were predicting it for next year, a whole range of numbers, some were as low as 130, 140, some were actually right back at 170. Stick 18, 20, 21 times that, and you end up the market that's somewhere in the 3,000 give or take range. That sounds about right to me for now. Look, it strikes me that in the near term, markets were too panicked when they were at their lows. They're probably ballpark in the right zone now. The bad news is, I don't know that leaves you a lot of upside. Now, I think you could see a bubble happen just as it happened post 98. But look, as an investor, I don't know that I really need to be in the business of trying to go and trade bubbles. So from my perspective, the value is definitely materially less at this point. There are pockets of value, but overall, it strikes me that probably what's going to happen in the next bunch of months is you'll get a lot of volatile movement, but when you step back for a bit, the market's probably not going to go very far. Now, when you get further out, I'm pretty nervous, right? I mean, think back to the end of 2018. With the economy strong and worries about the Fed tapering, markets plunged 20% in the straight line right at the end of 2018, right? The taper tantrum of 18 and 19. Think about how bad the next taper tantrum is going to be. So the problem we're going to have is that there's a piper to be paid here. And when all this stimulus starts coming out of the system, it's going to be a very miserable and difficult market environment. And so it strikes me that near term, I'm not so stressed. A vaccine would be all the better, obviously, for many, many reasons. But it strikes me that as you get into next year, things are going to start getting more challenging very quickly.
Could that tantrum, it's going to be one heck of a tantrum,
it's going
if you're right, could it be, is that 2021? Is that a 2022 event? Is it possible to even predict at a macro level when the Fed and other central banks are going to feel inclined to withdraw liquidity?
Look, I think at some point, it's not even about whether they're withdrawing it. It's about the incremental movement and whether it's incrementally more or less, right? The incremental motion's already stopping. And if anything, look, what we have observed is that first, the US was the most aggressive of any country on earth in fiscal and monetary stimulus combined, right? No one had the double barrel shotgun that we did and fired it so quickly. That has helped our economy massively, right? I mean, disposable income and savings actually rocketed during the pandemic, right? I mean, isn't that crazy? How do you have unemployment of almost 20% and actually have savings, rocket? And the answer, of course, was stimulus, right? That's going away. And again, it's incremental. Even in the last 4 weeks, you've seen savings start to drop just because at some point people start putting money back to work. So look, from my perspective, I think the rate of change is already something that is already starting to slow down. Markets will look ahead. I don't think markets are going to wait for the day that the Fed starts moving. Markets will be well ahead of that, right? So if the Fed starts moving in 2022, as an example, you would probably guess that sometime in 2021, people are going to start getting pretty darn nervous and anticipating that.
What's your highest conviction investment right now?
I think we still love our managed care investments. But I think to really find value, I think one has to look abroad because elsewhere stimulus was less active. And as a result, there'll be less of a piper to pay at the end as well, right? So the economic curve has been a bit worse elsewhere because of less stimulus. But as a result, you've seen ironically better values, but also a better path here. So for us, for example, we have found great opportunity in a number of Japanese stocks that really traded at ridiculous levels, I think, during the pandemic. And right now, for example, we own several of the top private Indian banks. And I think these are among the world's very best long-term investments. I know it sounds a bit, esoteric or exotic, but the best bank in India is a bank called HDFC Bank. This company has grown earnings at least 20% a year for at least 25 years in a row. I mean, talk about a growth stock, right? I mean, if it was in the US, it would trade at God knows what, 150 times earnings, if you look at what things trade at these days. But you can buy the stock at 20 times earnings for a company that essentially rolls out of bed and will get 20% earnings for years to come. And everything that's happened, including the pandemic, has helped. The real simple story here is that the government banks in India used to be essentially a monopoly. Over the last number of decades, private banks owned by stockholders have been taking over. And these government banks are simply incompetent messes. I mean, literally, when people go on strike, you can't get your money. I mean, it's absolutely insane. There's no air conditioning in their offices. The elevators don't work. And so every year when there's credit growth in India, it goes in the hands of the 30 or 40% of the market that is private. And so if GDP in India grows, 8, 9%, these banks essentially roll out of bed and grow 20% plus, right? And they do it and they can cherry pick the very best customers and the very best credit. So for us, look, I think if you can buy a company that has gotten stronger during the pandemic, not weaker, and where your valuations have actually gotten better, not worse, and your outlook for earnings is high conviction and high, then that's a great investment. So for us, if I had to pick one thing, that would be it.
You've got big positions in Google and in Facebook, and some people might wonder why those companies, when perhaps on the face of it, Amazon and Microsoft were better positioned for the pandemic.
So a couple of things, right? We've owned them before, and the reasons still hold. So are they better or worse positioned? Look, I think any company that's going to have advertising exposure will be hurt if the economy doesn't do well. The question is how much. For us, what we like about those two were that as an investor who cares about spreadsheets rather than just sound bites, it actually is something that we can actually go and gravitate towards and have conviction, right? I mean, in a volatile environment, most of all, I said, know yourself, and make sure you're doing things where you can hold your conviction and you're not going to get scared at the worst moment. So Amazon, is it a great company? Absolutely. Would you like to be Jeff Bezos? Sure. The problem is I don't have a clue what multiple to put. I mean, is it 100 times earnings? Is it 200? I mean, Zoom is a great company. Is it a great company at 265 earnings or 165 times earnings or 300 times earnings? I don't know. And I'm not sure anyone knows. I mean, it's just a theme investment, right? With Google and Facebook, you don't have to go and be a new paradigm guy. Traditional multiples on traditional metrics work just fine. And frankly, for both those two specifically, on top of it, you get something extra for free, right? In the case of Facebook, as an example, WhatsApp is arguably becoming one of the most important franchises in the entire world. Less so in the US, but in Europe and especially in Asia, everyone uses WhatsApp. They don't make a penny from it. And if anything, it's actually costing them money because it's an expense center, not a revenue center. So Facebook is really Instagram, it's Facebook, and it's WhatsApp. Facebook is itself a mature business. That's nothing particularly exciting, but you're not paying 40 times earnings for it either. Instagram is still a great business that's still growing. And WhatsApp is a completely untapped, incredible franchise. So for us, it's a decent multiple and you're getting stuff for free, right? And Google, frankly, the same way. Google is a incredible franchise. Yeah, it'll have some cyclicality to it, but they've also spent a fortune on things that simply haven't shown up yet in value, but someday will, right? Whether it's automated driving or all the other 100 things that put money in. And so, look, I think here, if there's any one company where I have high confidence that they are going to have their fingers in all the important pies down the road, to me, Google is as good an example as anyone. And so to us, it was a combination of great franchises, great price for the investment, right? Because ultimately, agreeing with someone that something is a great company, but having the price be crazy doesn't really get you very far, right? You need some bargain. And so for us, these are the only two of the big stocks that we really felt fit that. Microsoft, I wouldn't really have a quarrel with. With things like Amazon, you start getting into territory where I think it's a theme. And I think it's a great theme, but I don't know how to go and value it.
Is it fair to look at the incredible reflation in stock prices and the prices of other risk assets, and furthermore, the profits that banks are making in this crisis, and say the Fed bailed out Wall Street, bailed out the people with capital, bailed out the donor class?
Look, I think the Fed, I think, has look. If there's a problem, I think it's that more and more over the years, our government has become dysfunctional, and as a result, had to rely upon the Fed to act. Right? There are better ways to do things in every crisis, but look, I think it's hard not to be dispirited when you look at our leaders today. Let's not get into politics. Most people can guess mine pretty easily, but I will tell you that it's just shocking how our great country has become run in such a ridiculous way. And so what's ended up happening in the last two crises is that you've had the Fed essentially was the only guy there who actually had the ability to go and act without dysfunctionality and fighting, right? At least in the financial crisis, frankly, at the beginning. We saw this firsthand. I mean, I think there are many people that, I knew in government that was on the phone with all the time. At least in 2008, I think what George Bush did incredibly well was to set politics aside that fall and say to his team, Hank Paulson and others, do what needs to be done. And so for some handful of months, there was a real partnership among government leaders. That broke down pretty quickly once you got to 2009. This time around, it never even started, right? And so good news is at least the crisis was so dire that there was some fiscal response. But look, I think ultimately, I think in this country, if we rely on the Fed to be the fireman all the time, and the Fed only has a couple of tools, then anyone who is a beneficiary of those tools is going to end up being better off. But the Fed can't just write checks and send them off to people in the way the government can. And so all it can do is reflate asset prices, and that creates more and more inequality, right? So how do you solve it? The Fed's doing all it can. The problem is to not always force the Fed to be the only guy to do something to get our political act and house in order so that we can actually show some competence in how we react to crises and not just rely upon the Fed.
Dinakar, thank you for sharing so much with me. I really appreciate it.
Erik, it's my pleasure. I look forward to seeing you in person someday soon.
Soon.